So essentially, for those of you who've attended these before, this is a annual survey that Mercer does published. Essentially, it's looking at almost $6 trillion in US dollar assets across 15 markets, and you will note that it's mainly emerging markets. And my comments will very much relate to where we're similar and different to what you see in terms of those over asset allocation trends in those markets. The survey has been going for 8 years, so each of the figures I show will look at this year versus last year, as well as since inception of the 8 years. And this is prepared by Mercer. We give input on in terms of South African, as well as Eldorado in terms of the South American, Latin American. Just to note that these are figures we're presenting this year based on various periods in 2021. So, for example, the South African figures are at September for the Global Large Manager Watch data and end of March 2021 for the GPF data. Next slide. So what is interesting is to look at trends. And as you can see, the level of equity has increased slightly from the 2020 to 2021 figures. And that obviously to some extent driven by the fact that equity markets did a nice recovery over the course of 2021. So something similar coming through for South Africa, and mainly as a result of decreases in fixed income allocations. Next slide. We always look keenly at how we compare to other markets in terms of equity and bonds, but also keenly looking at alternatives. So it's interesting to see South Africa comes through here as almost a 60-40 equity versus bonds. A relatively small allocation to alternatives, and obviously a lot of that will come through the GPF allocation. Other markets similar to ours, the data included in this survey will relate to, for example, sovereign wealth funds, big government pension funds. So not surprisingly that there are large allocations of alternatives in some of those markets. We definitely private sector, not as high, and this would mainly be driven by GPF. Next slide. Interesting for us in South Africa at this stage is the allocation to offshore. So I'm sure Mandisa will include some comments on that. You can see that internationally, the split of domestic versus foreign equity is almost equal. In South Africa, the figures, because they're 2021 figures, show a much smaller allocation to offshore than you'd see for international investors. And as I said, because the GPF actually does a very low allocation to offshore at this stage, that is why it maybe looks very low if you're just looking at it coldly. Obviously, a lot of the international funds also have allocations to fixed income. And just remind that a lot of those would be defined benefit funds, as is our GPF, whereas the rest of our data is very much focused on defined contribution. Next slide. My last few comments will just be looking at some of the big trends and considerations in the international market, and obviously highlighting where we see something similar of concern to South African investors. Interesting to consider where the world was when this data was being collected and reporting on. Obviously, there was a growing focus on sustainability, which is definitely continuing and is a growing interest in South Africa. There was concern about inflation, dramatically increased over year to date in 2022. And similar to South Africa, new regulations, policies, standard across the world. And then just the first one was noting allocations have continued to remain relatively steady. Next slide. The three themes that are definitely coming through very strongly, it was the consideration of changing of the guard. Obviously, that's been coming for some time, knowing that the central banks had built up large balance sheets and would need to eventually come right. Inflation was expected, interest rate rises. Changing of the guard, though, has become dramatically changed as a result of Russia-Ukraine war, as well as the ongoing COVID lockdowns in China. So change of guard, change of regime, massively a focus area now for investors across the world and in South Africa. Positioning for transition, very much focused on green energy and looking a way to do a fair transition, very much a focus for South Africa, and then looking for diversification. ongoing theme for all investors and definitely key for South African investors in returns as well as protection. Next slide. So I'll just then end with 5 actions for investors to consider in this rather volatile time when the world's changing and a lot of uncertainty. Alternative strategies, I think, are key environments like this. Alexforbes Investments does do key allocations to hedge funds as well as private markets, getting this concept of having risk-adjusted returns that actually make a lot of sense in this time of volatility. China has been a big question for investors. South Africa, obviously, we're affected by China, not only in terms of direct exposures, but also in terms of having exposure to Tencent through our own stock market, and also generally being driven by commodity demands. So what level you should assess, and is this a good time to go in China, is a key question, which I'm sure Mandisa will spend some time on. Inflation, a key concern given the levels that we're seeing right now. So any inflation proofing is definitely a concern. The sustainability focus will continue to grow, and obviously investors potentially looking at alternative strategies to gain access to sustainability. And then a question about challenging home biases. Interesting to have that coming through an international Mercer survey at a time when South Africa has the opportunity to take up to 45% offshore. We haven't necessarily seen a lot of moves from local investors, but that's to some extent driven by attractiveness of South African asset classes versus international. I'm sure we'll see more challenge to that home bias going forward. Thank you very much. I'll hand over to Mandisa.
Thank you very much, Janina. Good morning, everybody. I hope you are doing well and that you're not load shedding at this current moment. I'll go straight into the asset allocation insight briefing. So there's a couple of events that have happened over the last couple of quarters, which have been very critical for asset allocation. Without painting too much of a story, I think the truth is when we started off the year, we did not expect to be where we are currently right now, because there's been quite a lot that has happened. Considerable actually, which has caused the trajectory to be very different. If I think about my very first presentation from an asset allocation to the business, one of our themes was that we would have this year that is almost 2 parts, which the first part of the year would be one where there's a lot of consolidation. The Fed is trying to manage inflation and of course hiking cycle. But we didn't expect that to be so adverse, because in the second half of the year, we would then get this reprieve. Of course, we are in the second half of the year, and that has not happened. And so there seems to be quite a lot that is happening from an economics point of view that warrants us to take very cautionary stances when it comes to asset class and growth assets. And so just a couple of events that I think are very critical, even when we're discussing asset allocation. Not necessarily going to touch on all of them, but I think last week, the UK Prime Minister Truss unveiled a fiscal package that would be coming out, and that would essentially put a cap on prices, on energy prices. And of course, that is something that is very critical for asset classes and also businesses as well, because if it's good for asset classes, it's definitely good for businesses. And in doing just, back of the matchbox calculations, one of the comments that are coming out there is that this could potentially add about 6% of GDP to the UK. Obviously, that's very considerable, given that a couple of months ago, we were talking about the UK being in a recession, and largely because of energy prices. So obviously, the scheme does mean that we get reprieve now, or we get to breathe now, being UK investors. But later on, it will obviously, someone's got to pay for that. So that's a worry that will have to come onto the fore a little bit later in the horizons. I think it's clear that the Fed is maintaining a hawkish stance. Got a couple of comments that I want to share on that, so I'll quickly, kind of browse through that. Janina spoke about China. China is a very big issue on our side, potentially, and I think one of the biggest issues now has been the fact that China is extending its lockdown in the Chengdu region. It's a very big metro city, and it's one that we were expecting to come out of lockdown at the start of September. So all of that were ticks that we were looking for within our China view in order to upweight China. At the current moment, we're actually moderately underweight China, and we were thinking that China was going to be that region that actually really does well in an environment where every other region is suffering. And obviously South Africa would benefit from that, given that there's a few businesses on our platform that are directly related to China. That has not been the case. I think the stance on COVID, the COVID or lockdown policy has proven to still remain quite strong, and to the detriment of I think businesses. But I'll touch on that a little bit more later. I've just got a slide to kind of that addresses some of those issues that we have. Of course, Russia came out again, I think it was last week, saying that they're actually cutting supply to Europe. Very critical from a growth perspective, because essentially Europe is an environment that relies in a heavy way relies on Russia for gas, supplying of gas, and with Russia coming out to do that, because of obviously some of the sanctions that were imposed on them, they don't like that. That just means that, you know, there's a huge question mark with regards to what is going to be happening to Europe. I've read a couple of papers around this point, but it's too early to say, I think. But it seems as though there's two views that are starting to emerge right now. Of course, one of the views is saying this is going to be very bad for supply, but the contrarian guys that are actually talking about the fact that Europe has actually been anticipating the winter, and so they do have quite a lot of stockpile. So maybe it may not be as adverse if Russia does continue to cut supply to Europe. It may not be as adverse as we're thinking. I think the jury is out there. You know, we have yet to see, but I think it's definitely going to be critical for asset classes going forward. South African GDP is another one, point number 5 there that has come out. Obviously, GDP contracted. We've had quite a lot of things that are going on the ground. KZN floodings, load shedding, which load shedding has been proven now. You know, we've got the numbers now that show that load shedding does take away from growth, and not only growth as well, but it takes away from profits also within businesses. So not a great environment for SA. The numbers sort of show it. And of course, the ECB in raising rates, I think everyone is sort of doing that at the moment. Something that I'll also touch on a little bit in depth later on. If we look back at June, in fact, maybe at the start of the year, all the way up until June, what is very, very evident is that markets have actually performed quite badly. In fact, if you look at this chart over here, which kind of shows you these different environments and how these were performing at different periods of time, even if you cut the pie on a 1-month basis, a 3-month basis, or even year-to-date basis, it's clear that most markets were in the red. You actually needed to be invested in just a few areas. Now, from an asset allocation perspective, this is a little taboo to say because we always use the phrase diversification is the only free lunch. It hasn't been the case because actually you didn't have to be diversified. You only needed to be invested in energy, in the commodity index, as well as oil. That's the only thing you needed to be invested in, because even if you diversified, you were actually in the red. And so it hasn't been a great environment for equity investors. In fact, it's been sideways from 2021. If you just look at this line, you can actually draw a straight line across this, and you can see that even when we made our profits in 2021, we sort of have to give those back recently. It hasn't been a great environment. And that's not surprising, because if you look at a lot of different signals, the signal has actually been quite clear, and the signal that is clear has said that we need to be steering clear. Bit of a tongue twister there. But the global economic activity surprise index has been one that has been trending and has been trending higher actually, but has sort of come down more recently. But essentially in between these huge trending lines, you can see that there's been periods of very volatile states. And essentially this surprise index is saying, is the market getting surprised by the numbers that are being released from an economic point of view? So if growth is coming out, is the economy expecting, the market, sorry, expecting more growth or less growth than what is being published? And it's clear that as this line sort of goes up, volatility goes up, because we were getting a lot of surprises in the first half of the year. The war's one of them, and maybe not so much in the second half, but still there's a lot of volatility happening in between. Treasury yields. Now, in any asset allocation presentation, you know, I think you'd sort of be very clear that in any environment of rising treasury yields, you actually want to stay away from equities. Now, since 2019, we've been having this period where yields have been coming down. Amazing period for equity investors, because essentially you're lowering the risk premium, and equities just look more attractive by virtue of them just being there. But it hasn't been that case. From 2021, you can see that that has been going up to levels that are even past 2019 levels. And I think, we've kind of talked about this, how this is, I think, Janina touched a little bit on the changing of the guards. Essentially, that's just trying to say it's a very different environment to the one that we've experienced over the past couple of years. EM corporates are struggling now to get funding. And that's what this line is showing you, that, again, it's been a tough environment. 2022 has meant that you're now paying up even more as a corporate to even get money. You have to compensate people even more. There's a lot more risk that investors are now scared of. And I think one of the main reasons for that actually lies in this chart. We sometimes get questions around, when do we think the market is going to turn? And, there's a lot of, you can kind of talk about that. It can be around a braai or something, and you can talk about your own views as to what you believe the Fed should have done, what the Fed could have done. But the truth of the matter is that the dollar is very much a catalyst. The turning of the dollar, in fact, when the dollar weakens, that is a catalyst for when markets start to turn. Of course, the dollar also turning means that yields will also be turning around. So there's a lot that's happening, but essentially once currency begins to get a little bit, it begins to slow down, and this being the dollar, I think you're going to start to see a different trend. Emerging markets, this orange line has meant that a lot of emerging market currencies have been weakening, just like the South African rand, and so forth, also with Japan as well, which is actually seen as a safe haven. So you would expect it to be doing well in this environment, but that has not been the case. It seems as though the dollar seems to be gaining a lot of momentum, not a great environment. Again, one last point on this changing of guards, this changing regime. If you look at the period environment since 1965, I think you can see that the trend of core CPI in the US now, as well as real GDP growth, was one that was trending higher. So that was slightly different. It obviously trended downwards, and that changed. So we saw growth slow down. We saw inflation also slow down. And we've been in this period, which some like to call the Great Moderation. And it was a bit of a volatile period, but more or less, I think, if you look at the chart and you look back, you can actually see that not a lot of movement that was, that was happening. Their growth would ebb and flow. But CPI was very much subdued. That is not the case anymore. It's clear there's been this cut that has happened, and now we're experiencing an environment where GDP growth post 2015 was accelerating, and inflation is also now starting to accelerate. Of course, I think we expect this to sort of come down as the Fed continues to hike cycles. This essentially means that we've been trying to find frogs, not frogs, but the princes amongst the frogs, and that has meant that this hopefully represents the market, the princess here, and the frog here, even though it says Bitcoin, really can be anything. And I think at one point this was small caps that looked really appetizing. After the fall, after we saw the bear market, everyone was now talking up small caps. You need to be investing in small caps. So it's time to come back to equities. And you sort of had to trust. And some people have gotten badly hurt in that environment. And I think we're going to continue to suss out the princes among the frogs. It's this environment where you're going to have to find opportunities. The main reason for that is actually in the statement that Jeremy Powell made. And I'll just touch on a few comments that are so critical in what he said. And this was at the Jackson Hole meeting, which was very, very anticipated by the market. Surprisingly, it seems as though post the Jackson Hole meeting, some market participants feel as though there's something that has changed all of a sudden in what the direction that the Fed was going in. And I think part of that is because the market was expecting that the Fed would start to pivot or slow down. So there were these two, definitely two sides to this coin, or two big groups that were starting to emerge. One group that was saying, no, the Fed is going to continue. And I think I was probably in that group that says the Fed is going to continue to put its foot on the accelerator, while the other group was saying no, the Fed is going to start to pivot. They're going to start to talk about when they'll be slowing down, and that's not what happened. Powell said he wants to restore price. Restoring price stability will take some time and requires using tools forcefully to bring demand and supply into better balance. I think that word forcefully must not be taken for granted, because essentially they're saying they're not going to go easy on the economy. They're willing to sacrifice growth in order to tackle inflation. That's a huge thing. We haven't seen that in the last couple of years. In fact, since Alan Greenspan, we've been in an environment where if there was anything bad that happened, QE was the answer. And now essentially they're saying that they're not going to be doing QE. They're actually going to be in an environment where they're actually tackling inflation, and they don't care about growth. So the Fed has always been growth focused, and that's not the case. Another thing which is changing. I think some of the other points, they speak to that point as well. And so if you go and look at the performances of the different sectors and the different markets, it's clear to see that everything has been down, even over the last quarter. It's been down globally. It's also been down in SA. If you invested in South Africa, you actually needed, from a year-to-date perspective, to be invested in bonds were positive as well as cash. But if you look at these numbers, I think one of the things you need to take into account is that even if you were in bonds alone, you still didn't make enough to beat inflation. So inflation is if it was an asset class, we'd say it's the asset class to beat, and it actually really is. Everyone is trying to beat inflation at the moment. So if we look ahead, everything that I'm going to talk about now and try to cover in the next 15 minutes is really going to be as a result of our process. We've got a 5-pillar process which looks at valuations, the economic side of things, and this is our economics house view. It's got the macro regime view, which we take into account. It's got sentiment, it's got currency as well, and so all of these are extremely important because these 5 pillars speak to what we think will continue to go on. Currency, I touched a little bit on the dollar, and essentially that's what we're looking at. We want to see the direction of the dollar because that is the most critical thing for global assets in particular, and I'll show you why I mean global assets. The current environment is one that is either cheap or attractive from a valuations perspective, so we're not concerned there. Valuations are actually not the thing that's concerning. I mean, you can debate that some of these markets are still quote unquote expensive because they are not taking into account this fall in earnings that is potentially coming through, and I've got a slide actually on that. But essentially, even if you just closed your eyes and you kind of just put your pen anywhere, you could invest anywhere. This is just saying everything is cheap or it's fairly priced at the moment. Now the slide, the chart on the right-hand side says actually valuations are a good measure for South Africa. So if you're seeing South Africa in the green, that's actually a good thing, because in South Africa, if you take the trailing PE alone, which is the first column over here, and you look at 5-year forward earnings or real returns going forward over the next 5 years, how much would you get? Would the PE or the cheapness of the stock actually result in positive returns? And you can see that's the case, because if the cheaper you go, which is this side, you're actually getting positive returns for that. And as you go more expensive, you're not getting positive returns for that. There's a give or take for that, but essentially it's saying if the PE multiple is at 10, over the next 5 years, you're expecting to get about 9.7% from equities. Not so in global equities. In fact, it's very difficult to sort of draw this line because you can see it's scattered everywhere. The cheapness of a stock alone is not going to give you an overview of what the stock will do over the next couple of years. So from a global perspective, it's so important for us to understand the dynamics of what's happening offshore. And so, of course, China has to come into the fold. China's one that's very critical from SA's perspective, from global perspective, when we look at emerging markets. And of course, as I mentioned, China was one of those economies that, because they're very different in terms of where they are in their economic cycle, we were expecting that market would do very well, while other markets are continuing to struggle. Now, if you look at earnings, over the last couple of years, what you can clearly see is that over the last couple of years, over the last year, maybe last couple of months, China has been in this earnings recession where the earnings has actually been trending down while other markets have had positive trends. We've got little signs of this abating, unfortunately. And I think as the Communist Party Congress draws near, I think there might be a bit of blunders that are happening then. And part of that has been actually highlighted in this property sector slump that's been happening. And property sector is very critical in China because essentially it makes up a big part of GDP. So when you're not getting funding, when the people are not, when construction is not booming, you see that in the numbers. And so they need to fix that. And we haven't seen, they've talked the talk, but we haven't seen them sort of doing what they need to do. The benefit of that is that things happen very quickly in China. So that could change overnight. So that's something to watch very clearly. And of course, the third point are these subvariants that are happening. Anytime we see a new subvariant or this or an outbreak, China has to be your concern. It has to be something that comes to mind because they have the zero COVID policy rule that comes up. So on the 28th of July, they had a Politburo meeting, which was amongst a couple of Congress individuals, and they stated out a couple of points, and I've just highlighted 4 of them. One of them said that economic growth target would now be phrased as keeping within a reasonable range. So at the start of the year, they'd actually communicated to the market that they'd be targeting about 5% to 5.5. It was actually more 5.5% in growth. And of course, COVID hit them, and then they closed down the economy. And so they've gone back and said, you know what, guys, we're actually not going to be targeting a range anymore. We're going to be doing a reasonable, we're not going to be targeting a particular number anymore. We're going to be doing a reasonable range. We obviously knew already that the number of 5.5 was not going to be a reality. The second one is that they had, the comments sort of made it seem as though, you know, the new stimulus packages and everything that be doing, even number 4, that they'd be trying to balance this dynamic zero together with growth. Now, I'm struggling with this number 4 because most recently, and I think I sort of mentioned that point on them not actually opening up Shenzhou, that mega city region. I think that's a direction in the that they've gone in the wrong direction because they sort of communicated one thing and they're doing something completely different. There's another press release that's recently happened where they've sort of said that they're trying to be more cautious now. There's going to be a lot more testings that are going on, and I think that sort of goes against what they communicated on number 4. So we also have to take these things with a pinch of salt. Number 3 is a positive one. They said they're going to try to maintain market stability. So it seems as though these things are bothering them. Some of the things we're watching, like property market, things that are happening from a financials perspective, is something that's concerning them. So China's one that we think you need to watch instead of going into it extremely quickly. I don't think it's the time for that at the moment. From a valuations perspective, we're actually not worried. You can see that they're fairly valued. It's not an expensive market that you want to stay away from. It's more fairly valued at the moment. The economics part, I think some of it I've spoken about, so I'll kind of go through these things very quickly, but this one is the most critical one, I think, for us, and it is the theme of this presentation today. You don't want to fight the Fed. You know, that's something Martin Zweig sort of coined, a phrase that he coined in his paper, but essentially you kind of want to fight the Fed at the same time. It's a bit weird to say, but you don't want to fight the Fed. And that means in a booming cycle where the Fed is pouring liquidity, and that's what they've been doing since 2015, since the 2000s, early 2000s. You wanted to be in growth asset exposure in places where that will benefit, that will be of benefit. Hasn't been the case more recently. So you don't want to fight the Fed, but you actually want to fight because inflation, which is what we are benchmarked to, is quite high. So investors are asking, will my investment be able to kind of outperform inflation? And so we have to manage that, right? That frog finding the princes amongst the frogs. And you might end up kissing some of these frogs and they're just frogs. But you sort of need to kind of come back to yourself quickly if you make the wrong decision, because you never know if it's wrong until afterwards, and sort of align yourself to that. And I think the reason why we will still experience very hectic bouts of volatility is because of this picture. If you look at what the Fed is anticipating in terms of projections, these green bars, they've projected that this is where the interest rate will be as in 2022, at the end of 2022 and 2023. Of course, these are changing every day. You know, Powell's going to speak to the market again, so these pictures might change. What is very important is if you look at this bar as well as this bar, which is what the market is pricing, this is what the market was pricing in June, and this is what the market is pricing now. You can see that the market is a lot more conservative. They don't think the Fed will hike by that much. even more so in 2023, the Fed has actually anticipated far more higher interest rates than what the market is pricing. Now, wherever you get this dichotomy, you are going to get lots of liquidity volatility. And I think once that starts to happen, where either the Fed comes and meets the market or the market comes and meets the Fed, it's going to be very difficult for us to say that this trend in having these jumps in, and we call those, bull market rallies, and then it comes down again and it jumps up again. I think that trend is going to continue to go on. And of course, our earnings view is one that we're very concerned about for reasons that I've kind of spoken about. But one of the main reasons is, the economy is going to be struggling, and we think that earnings are going to be following suit after that. And our economics view as a whole actually essentially says that we are very much on the bearish side. You can see there's lots of bearish areas, very few areas of bullishness at the moment, except for fiscal policy in other regions, because obviously they're trying to make sure that it doesn't go above board. I think it's obvious in what I've spoken about that what the Fed is doing is resulting in tighter financial conditions. You can see that financial conditions index is moving now out of loosening territory towards tightening. And that obviously does mean that it coincides with the stock market. So whenever you see this trend where financial conditions are tightening, the market follows suit. Until that changes, we think that's going to continue to be negative. And of course, these are just some points that we look at and we track from a macro regime perspective to see if that's moving in the right direction or in the wrong direction. And that essentially becomes a recession risk indicator. You can see there's a lot of areas that are marked now as X's, which are recessionary, and a few areas that are marked as cautionary. We don't care that something is not an X, it's still cautionary. Once it's within cautionary and recession, we are worried. So essentially, it's just saying we've got a lot of signals here that are in worry territory, and therefore the overall signal has turned recessionary. It hasn't been the case. Obviously, we track it over time. And what that has meant is that when you look at all our different signals, that those have resulted in very poor fundamentals, and essentially it's telling us that the macro regime is not positive, it's not conducive. It's now in red territory. It was in neutral territory the last time we updated this, which was about a quarter ago. And so sentiment is one that is starting to now become a little bit more elevated. And this, I suspect this is more post the Jackson Hole speech where Powell said, we're going to continue to fight. And essentially you can see the fear index sort of started to trail up. It was doing very well. That has sort of started to trail up. In fact, when you look at it on a year-on-year, week-on-week, month-on-month, it's now deteriorating. Hasn't reached 6 monthly, but we expect that to change into deteriorating mode. So volatility is beginning to rise once again. And currency, if you ask us about valuations, the dollar is expensive. This is now on a real effective exchange rate, which looks at more short-term inflation differentials. Once it's on this side, you can see that that's expensive territory. The good thing is that it doesn't stay here for long. And I think that's something to watch. Of course, one would argue that we're in a very different regime right now. And that could, as with one of the comments that Jeremy Powell said, is we're going to continue sustainably doing this for as long as we need to. So one could argue that maybe it will actually stay here for much longer than it's been in the past. And we'll see, the last time it was like this was in 2020. It's even gone past the 2020 levels. Europe, on the other hand, is actually cheap versus its real effective exchange rate. And South Africa is also cheap versus its real effective exchange rate. So if you were looking to buy a particular currency at the moment, just based on the real effective exchange rate, you might want to consider cheaper currencies. But I would argue that the direction of the dollar is one that might trip you off, because this chart that shows short interest rate differentials versus the G7 countries versus the US dollar, actually not in your favor. So as the Fed continues to rise quicker than other G7 economies, which results in interest rates being far more higher in the US than the rest of the world, then that props up the dollar. So until we see this trend changing and that sort of starting to come down, I think the dollar is going to continue. Not a great environment again for real assets. And so what am I saying? Essentially, last 2 minutes of this conversation, I'm saying yes. We're not saying this "don't fight the Fed" a comment is not real. You don't want to fight the Fed. Whatever that the Fed does here, it's Powell and Yellen obviously digging a grave and covering price discovery up, because essentially everyone trades according to what the Fed does. So you don't want to fight that trend. But unfortunately, as an asset allocator, you need to find ways to fight. And it may not necessarily be you positioning your portfolio strategically against the Fed, but it might be you finding opportunities and ideas. And I'll kind of highlight what those are for us. If you were asking me what the landmines are that I'm really cognizant of right now, I think these would be the four. The energy war in Europe is one that I've sort of touched on now. It's a war now because obviously of what Russia sort of came out and said that they're going to be stopping supply to Europe, and that's a form of war. It's something to watch, could potentially turn out very badly and sort of filter into the markets. Obviously, it's going to be bad for the European economy, but that could also result in the rest of the rest of the world as well. The other one is the restrictions that I've kind of touched on in China. Very critical for China. We still have hope, crossing fingers that China will step up, will step up and perhaps maybe loosen the defenses. But from if I'm being honest, from some of the commentaries that are coming out from China, it doesn't seem that way. It doesn't seem like it's going to be that way in the next 3 months. We were expecting that mid-autumn would be that time where you're starting to see a tick up in tourism, but they've actually come out and said that they actually recommend people to sort of stay home, and they are upping the way in which they testing people. And of course, escalation of the US-China relations. A lot of people don't know, but China's trade with Russia has actually remained quite significant, and it actually has been growing. So that belt, that radar that they had, actually still continues to be quite robust. And a lot of people have sort of overlooked that. But I don't think that's the major concern. You can either say China will, something might happen because of China versus Russia, or it could be because US is having very close relations with Taiwan. And the US has actually also been deliberate in saying they want to make sure that they are seen as people that will come to Taiwan's aid. And that has not come very nicely to Chinese authorities. They've actually also voiced out that they don't like that. There's been 8 people alone that have come from the US to Taiwan. And apparently, if you look at the last 10 years, that number is actually very high, because in general, they only send 1 person or at most 2 people. And this year alone, in the middle of a war that's happening, in the middle of heightened geopolitical activity, in the middle of China saying, that they don't want the US so close, the US has actually sent 8 officials to Taiwan. So that's something to watch. And of course, China's currency, I think that is something that could end up being very critical as the Chinese currency begins to weaken. That takes away, it makes other economies like South Africa quite vulnerable, because it removes the competitive advantage in other economies, and it sort of shifts trade towards China. So not a great environment. And I think if you then asked me, from a whole pillar perspective, because these are the pillars we focus on, what do you think is a concern? Valuations are positive, the traffic status. Valuations are in the green, but everything else is something that is actually in the red. So the SMAC regime is actually also in the red as well. The economics is red, MAC regime is red, sentiment is more cautionary at the moment, and so is currency in the red. So it's something that we are very, very concerned about. These are our final views, and these are tactical moves that we made, and we make these, we adjust these moves often, and the reason we do that is because everything changes within a particular time. But you can see very little areas of being overweight, except for uncorrelated assets, because they add gold, protects you from volatility, and the US dollar as well is strong overweight because it's strengthening. We think that's going to strengthen, and the rand, we saw it as neutral because we think it does have some kind of cushion with the commodity cycle at the moment. But yeah, it seems as though the dollar is just going way too fast for that, and that's something you might even want to downweight perhaps going forward. I'll stop here. This is my last slide. I don't think I have anything else after this.